Welcome to RSM's Housing Association VAT and Corporation Tax Update. There are a lot of tax issues for housing associations to consider at the moment, particularly around VAT, and during this session we will run through the issues that have the widest application to the sector. My name is Daniel Guy. I'm a VAT specialist and have focused much of my time on the housing sector over the course of the last 15 years. You will see my contact details on this slide. Please do get in touch with me if you would like to discuss any of the issues that I will cover today further, or to have a more general chat about VAT and tax issues affecting your organisation. Firstly, I thought it was important to mention, for those that don't already know, how active Hmrc are in the sector at the moment. Hmrc are doing a lot of visits in the sector using their specialised team from Manchester. The visits are being carried out using teams, and this is giving them the ability to cover a lot more ground. The issues that they are focusing on can broadly be put into four headings. Income. So each income stream of the housing association is discussed, and Hmrc are obviously trying to identify income streams where VAT should be declared. Housing management arrangements are a particular focus, particularly where housing associations are working together, providing services to each other and to tenants. Full VAT recovery on costs is also a focus. Hmrc want to confirm that any full VAT recovery is only on costs that directly relate to the taxable income streams. As always, partial exemption is a key theme. Hmrc are keen to review the calculation and also discuss the approach and process that is carried out. It's definitely an area where errors can be found, particularly where the calculation has been passed to new staff members or the activities of an organisation have evolved since the calculation was originally set up. Finally, Hmrc usually want to discuss non-business. Hmrc are therefore keen to establish what activities are carried out for free or which are wholly grant funded. If such activities are significant, Hmrc will explore whether a further restriction to overhead VAT recovery is required. With our involvement at visits, we have usually been able to prevent a further restriction. We have a much more detailed breakdown of the areas Hmrc will cover, so please do use my contact details to get in touch if you'd like to talk through those in more detail. I would now like to touch on a couple of areas in relation to capital expenditure. Usually there is no difference between VAT accounting applied to revenue or capital costs. This is unless of course the expenditure relates to a capital goods scheme item. In my experience, a capital goods scheme item for a housing association is usually created where VAT is incurred on the purchase or refurbishment of a head office. If qualifying, the use of the asset must be monitored for 10 years, and if use changes, adjustments must be made after the end of each VAT year. A change in use will be relevant if the partial exemption percentage of the organisation changes, which usually occurs every year. Further changes might be if additional space is rented out or activities within the building change. The complex rules around capital goods scheme are often misunderstood across all sectors. However, in the housing sector I often find that adjustments are stopped prematurely. This might be because of a merger, a change in staff, or not understanding the length of the requirements. It is a serious compliance issue and one which is also on Hmrc's agenda at VAT visits. I wanted to focus on this topic today because due to the current situation, several of my clients have talked to me about changing how they use office space. For example, leasing part of the office to the NHS has been discussed, or creating training space that can also be used by third parties and generate additional income. Such changes are likely to require CGS adjustments where relevant expenditure has been incurred in the last 10 years. Finally, when considering these issues for clients, we've noticed that capital expenditure is often posted as gross, and therefore VAT recovery is not considered as part of the VAT return process. This may present you with an opportunity to identify under-recovered VAT if you apply these rules when you're coding your expenditure. I would now briefly like to mention making tax digital. I'm sure that you are all now submitting VAT returns and using appropriate software, and that your records are in line with relevant guidance. The next step to making tax digital is ensuring that there are digital links from the raw data processed into your relevant systems all the way through to the final VAT return figures. For the vast majority of housing associations, this will require an export to Excel and then ensuring that the VAT return spreadsheet workings are compliant using appropriate formulas. Moving chunks of data around the workings via cut and paste will not be allowed, and many housing associations still have work to do in order to identify the best way forward to solve this issue. It is very much a case-by-case basis to identify the best solution for each organisation. We are able to help you by providing digital link reviews, and we can combine these with more general VAT compliance reviews. I would now like to move on to a more strategic area. Clearly, many organisations are trying to simplify the group structure and arrangements that they operate, and this slide summarises some of the key questions that you may be asking yourself or you may hear within your organisation. Firstly, in relation to design and build and market sale companies, do you really need these companies? Is the design and build company providing the necessary level of savings? And do you need separate vehicles for market sale and design and build? In relation to commercial entities, questions might be, do we need a market rent company or can we do it within the housing association? And do we need multiple trading entities or can we just have different brands within one entity? In relation to the housing associations, if there's more than one housing association in the group, questions may be raised about whether a transfer of engagement into one entity is more appropriate. Finally, at the bottom right hand corner of the slide, we've got joint ventures. Relevant questions might be, is there an opportunity to set them up contractually rather than creating new entities or special purpose vehicles? However, in our experience, this may be just as complicated operationally. For group simplifications, it is important to get tax support at the earliest opportunity. In order to get from the current structure to the simplified structure, there will obviously be a number of steps and transactions to go through. As VAT is a tax on transactions, it's important that these steps are understood in detail so that the necessary VAT treatments can be applied. The ultimate objective is to ensure that the correct entities end up in the remaining VAT group, that no unnecessary VAT costs are created along the way, and that the necessary notifications and applications are made to Hmrc. The remaining 4 bullet points on the slide represent other risks that must also be considered as part of the process. Losing an existing partial exemption special method is a key risk. Many of these methods are extremely favourable but were agreed a long time ago, and it may be difficult to re-agree such favourable methods. There may also be a risk to VAT shelter arrangements, and as those of you who operate them will know, these can generate significant payments each month on the VAT return, so we wouldn't want to jeopardise such arrangements. There could also be risks to other special agreements, particularly around VAT liabilities of certain income streams, and finally risks to option to tax decisions. So if an entity that has opted to tax is no longer in the group, the VAT group won't have opted certain properties and the VAT liabilities of that property could have changed. I will now cover design and build companies. Despite the drive for simplification, many housing associations are still considering implementing design and build companies, and rightly so, because the efficiencies and savings can be significant. However, it is essential that during consideration of whether to set up a design and build company, the following points are considered. I always encourage my clients to carry out a cost-benefit analysis because not all VAT in relation to developments can be mitigated through this arrangement. There are also additional costs to consider, such as internal administration of operating a new entity. Secondly, the necessary advice should be sought to ensure that the structure is set up and maintained on sound business principles. For example, invoices, contracts, payments must all be appropriate, and the accounts of the housing association and the design and build company should reflect the relevant activities of each entity. Also, a further consideration is that Hmrc have recently announced a pre-consultation exercise and requested a call for evidence regarding VAT groups. One point within this pre-consultation is whether VAT groups should become compulsory for corporate groups. This would cause a problem for this arrangement because each entity needs to be separately VAT registered, and the design and build company would usually be wholly owned by the housing association, creating one corporate group. If the new rules went ahead, that would be an automatic VAT group. Finally, there is a new drive for design and build companies because there is an increasing desire within the sector for in-house labour to be used on construction projects. The knock-on effect of such an arrangement is that an additional VAT cost is created on material purchases. However, the design and build company can be used to mitigate the VAT cost on these materials, which is an additional benefit to using such a company. I'm now going to briefly touch on the reverse charge regarding international purchases. Many of you will already be aware of this issue due to the VAT return preparation and due to a recent campaign by Hmrc in this area. Many of your organisations may have been assessed for failing to carry out the reverse charge. However, in general, these assessments were quite small. The process is that when services are purchased from overseas, VAT will not be charged on the invoice. It is then a requirement of the customer to self-account for the VAT on its VAT return, and for housing associations, this will normally create an additional VAT cost. For those of you involved in the VAT return process, you will know that you effectively have to add an amount into box 1 of the VAT return, and then consider whether VAT recovery can be achieved through box 4. The areas where such expenditure is incurred is usually in relation to the IT department or on credit card purchases. This expenditure can be difficult to identify for the customers, but Hmrc are aware of such purchases due to various international reporting requirements. It is therefore really important that this requirement is taken seriously, and is again another point that will be discussed on Hmrc visits. So, an additional reverse charge is being introduced to prevent VAT fraud in the construction industry. This reverse charge will be relevant to supplies made within the UK rather than just on international transactions, as I've just previously looked at. This new reverse charge is being introduced from the 1st of March 2021. Where it applies, the customer will be responsible to account for VAT, and VAT will not be charged by the supplier. Hmrc has confirmed there will be a light touch approach initially, but taxpayers must attempt to comply with the new rules. Working out when the reverse charge applies is the key requirement to ensuring compliance with these new rules. There is a very useful flowchart available in Hmrc Guidance which confirms the following key points. Both the supplier and the customer must be registered for UK VAT. The reverse charge will only be relevant where the service would attract VAT at the standard or reduced rate of VAT. So this won't include development of new dwellings, for example, as they are zero rated, as most of you will know. The reverse charge will apply on building and construction services that are subject to CIS, the Construction Industry Scheme. It is important to understand that relevant services are a lot wider than just construction, and many services purchased by housing associations will be relevant. However, most housing associations have charitable status and are therefore exempt from CIS. This means the purchase would then not be subject to CIS, and the reverse charge will not need to be applied. Furthermore, it is likely that housing associations will be end users, and any subsidiaries of the housing association will qualify as intermediary suppliers. Again, where these two statuses are held, the reverse charge should not be applied. So as confirmed by the previous slide, the reverse charge won't usually apply for housing associations. However, it will be necessary to notify suppliers of the relevant status so that they do not apply the new reverse charge rules. If the suppliers are not notified, they will stop charging VAT and leave you in a difficult position of being required to reverse charge, but incorrectly. In order to make notification efficient, it may be worthwhile working with your procurement and legal departments to amend contractual agreements and include the necessary notification requirements wherever you can. Also, where you have a works team that provides services to third parties, you should also consider the impact on you as a supplier. If the customer doesn't provide relevant notification, VAT should not be charged by you on relevant services. This is a complex area, but with the various exceptions, it should be relatively manageable for housing associations. We have recently provided a number of training sessions to our clients, including finance and development teams, and taken this opportunity to cover wider development issues, such as issues we've looked at today, like design and build companies and how to manage open market sales within the group structure. I am now going to touch on a couple of corporation tax issues. The traditional means of mitigating corporation tax liabilities in subsidiaries has been for the subsidiary to gift its profits to its parent charitable housing association. The issue with this is that the subsidiary must have enough cash and distributable profits to make the payment. It also means that the subsidiary is unable to build up reserves without incurring corporation tax liabilities. There is a way around both of these issues, which involves claiming tax relief in the subsidiary for interest costs incurred in the parent housing association. A number of our clients have used this to good effect. We recently used this to help a subsidiary that would have otherwise paid corporation tax of over £300,000. This opportunity was mentioned in last year's technical update, and at the time it was relatively new and untested. We have since implemented this with various housing associations with great success. We have fully disclosed the treatment adopted to Hmrc and as yet not received an inquiry or intervention from them. We're pretty comfortable this is a robust solution. Incidentally, interest costs can also be used to mitigate corporation tax on feed-in tariffs receivable by charitable housing associations. So if you're paying corporation tax on feed-in tariff income, please do let us know. If you would like to discuss these issues or any other tax issues, please let me know, or your usual RSM contact, and we'll put you in touch with the relevant specialists. Finally, I wanted to mention RSM's Health of the Sector survey. The survey is in its 14th year, and your responses help us to assess and report on the changing economic and regulatory conditions within the sector. You will find a link to the survey on this slide. It's still open, but it closes on the 5th of February, and we would really appreciate your input, so please do try and find the time to complete it. That brings me to the end of my presentation. I'd like to say thank you for listening. I hope you found the session useful. But please do get in touch if you have any questions, and I'd be pleased to arrange a call with you or provide further information that you require. Thanks again.